Welcome to Griffonomics.
It's great to be back.
Today is Thursday, February 19, 2026. I want to start us off with a mental image. I want you to picture a company that is quite literally a giant block of ice.
Okay.
It's massive, it's incredibly heavy, it is absolutely essential to modern life, and right now it is sitting in the middle of a very, very heated room.
And that room is Wall Street.
That room is Wall Street.
Mm.
We are looking at a real estate giant that keeps the world fed. I mean, this is the company that makes sure your frozen berries for your morning smoothie, the turkey for Thanksgiving dinner, all of it actually makes it to your table without spoiling.
They are the invisible, critical backbone of the entire food supply chain.
Absolutely critical.
Yeah.
And yet, despite that fact, despite being fundamental to how we eat, its stock price has been, well, battered. It's just frozen in this transition period, and it is testing the patience of just about everyone.
It has been let's say, a brutal winter for the shareholders. That is for sure.
We are talking, of course, about Americold Realty Trust. The ticker is, appropriately, COLD.
Yeah.
Cold-E.
You couldn't ask for a better ticker for the world's largest publicly traded, temperature-controlled logistics company.
Exactly. And the mission for this deep dive is pretty specific today. We're not just going to skim the earnings release that just dropped.
Oh.
You can get that from the news headline.
Yeah, that's the surface levels.
We're here to generate a really granular investigative report on how Americold is trying to navigate what I can only describe as a perfect storm.
And it really is the definition of a perfect storm.
Yeah.
I mean, you've got this glut of industry oversupply hitting the market.
Right.
At the same time, you have stagnant, maybe even falling demand from consumers. And then on top of all that, you have this big pile of debt that is making the credit rating agencies very, very nervous.
But there's a path out. Or
Yeah.
at least management is telling us there's a path out.
Right.
And that's what we're going to tease apart today. We've got three main pillars for this discussion. First, the boardroom brawl. The activist battle with Ancora that completely reshaped the board just a couple of months ago, back in late 2025. And this was not a polite knock on the door. This was a siege.
It fundamentally changed the governance and the power structure of the company almost overnight.
Second, and this is the one that I think is going to be the most surprising for people, is the completely counterintuitive impact of GLP-1 weight loss drugs.
Ah, the Ozempic factor.
The Ozempic factor. Everyone just assumes it kills food stocks because, people eat less.
Hmm.
But the data we're seeing here suggests something very, very different for Americold.
It's a fascinating nuance, and it really comes down to the difference between volume and value. And more importantly, the difference between dry storage and cold storage.
Yeah, and the third, survival plan. The really aggressive deleveraging roadmap for 2026, that's all about one thing, saving their investment-grade credit rating. So before we jump into the nuts and bolts, let's just set the context on why this matters. What's the vibe on the street for Cold-E right now?
It is a complete battleground stock. There is no other way to put it. You have two very distinct, very dug-in camps.
Okay.
On one side, you've got the skeptics, the bears, who see a classic value trap. They look at the debt, they see the occupancy numbers falling, and they're screaming, "Don't try to catch a falling knife."
Anyway, it's cheap for a reason.
Exactly. But on the other side, you have some very smart money looking at this as an asymmetric recovery play. They're making the argument that the stock is trading at a massive, almost absurd discount to its replacement cost.
Okay, replacement cost. Let's define that really clearly right up front.
It's simple, really. It's what it would cost you to build this company from scratch today. So if you went out right now with today's construction costs, today's land prices, today's interest rates, and you tried to build Americold's asset base, we're talking about 230-plus facilities.
Wow.
1.4 billion cubic feet of storage. The cost to replicate that would be significantly higher than the company's current market cap.
So you're saying it's cheaper to buy the whole company than to build the assets it owns?
By a wide margin. And you can't just, pop up a cold storage network like this overnight. It's not like building a self-storage facility.
Yeah.
This is a legacy that took them 120 years to build.
1.4 billion cubic feet. That's a lot of frozen pizzas.
Mm-hmm.
But let's be real. Being big and old doesn't mean you make money. I mean, just ask Sears.
That's a very fair point. Size doesn't guarantee profit. Legacy can also mean old, inefficient assets.
Right. So let's unpack the machine itself. Part one, the engine room. We have to understand the business model because Americold is technically a REIT, a real estate investment trust.
Right.
And usually when I think REIT, I think of a pretty simple landlord model. I buy a building, I lease it to you, I collect a rent check, and I go play golf. But reading through the briefing on this one, this feels way harder.
Oh, it's night and day.
It's
It is so much harder. Americold is what the industry calls an operationally intensive REIT.
right. So not just a landlord.
Not at all. I mean, the mental model of a REIT where you just, collect a rent check and that's the end of your day, that completely breaks down here.
So they're not playing golf.
They are definitely not playing golf. The warehouse segment, and you have to remember, this is what's driving, 91% of their revenue?
Yeah.
It's a full-on service business. It's a logistics company that just happens to own the real estate it operates in.
So they're actually running the buildings.
Yeah.
The labor, the forklifts, everything.
They're running everything. I mean, they're providing the labor, the forklifts, the complex inventory management technology, the energy management to keep the electric bills from going to the moon. They call it value-added services, and it's a huge part of the story.
Okay, give me some examples. What are these services?
Well, they don't just store the food. They
Yeah.
are blast freezing it, which means taking a product from, say, a processor and dropping its temperature incredibly fast to lock in freshness. They're doing kitting.
Kidding. What's that?
Think about the variety packs you see at Costco or Sam's Club. Someone has to physically assemble those packs. Americold does that inside the warehouse. They're also doing protein boxing, repacking bulk meat into consumer-sized portions, and they even have ripening rooms for produce.
Ripening rooms. Explain that one. That sounds fascinating.
It is. So if you're a big grocery chain, you have a huge problem with produce like bananas or avocados. You need them to be at the absolute perfect stage of ripeness the moment they hit the store shelf.
You can't have green bananas one day and brown, mushy ones the next.
Exactly. It's a logistics nightmare. So Americold actually manages that whole ethylene gas cycle and the temperature curve inside dedicated rooms in the warehouse. They're not just storing the avocado, they're actively managing its biological process to hit a delivery window.
Wow. So they are deeply, deeply embedded in the product life cycle itself, not just the storage of it.
Inextricably. And that, as we'll get to, explains why the customers stick around for so long.
Okay, that makes sense. But before we get to that, I want to break down the nodes of this network. The sources break down their revenue into 4 really distinct types of facilities, and I think understanding this is key because not all warehouses are created equal.
Not at all. And the mix is really important. The biggest chunk, it's about 40% of their revenue, comes from what they call forward distribution centers.
Forward distribution. What's the function of that? Is that like the Amazon warehouse of frozen food?
That's a pretty good analogy. These are the big mixing facilities located just outside major metropolitan areas. Think of a giant freezer complex outside Chicago or LA or Atlanta.
So they're close to the population centers.
Exactly. These are typically multi-tenant facilities. So inside one building, you might have 10 different food manufacturers storing their goods. Unilever, Kraft, General Mills, you name it. The whole goal is to be close to the population so you can get that food to thousands of grocery stores quickly. This is the last mile hub before it hits the retail store.
Got it. So that's the big distribution hub. Then next up, you've got production advantage sites. This is about 26% of revenue. This sounds different.
These are, in my opinion, the most fascinating and valuable assets they own. These are facilities that are located right next door to the major food processing plants. And when I say next door, I mean literally connected by a conveyor belt or a bridge.
Can you give me a concrete example of that?
Sure. Picture a massive French fry factory out in rural Idaho or Washington state. On one side of the facility, potatoes are coming in from the fields. They get washed, sliced, blanched, fried, and bagged.
Okay.
The second those bags of fries are sealed, they're hot. They need to be frozen immediately. So they travel on a conveyor belt through a hole in the wall directly into an Americold blast freezer.
So Americold is literally the freezer room for the factory.
It is the freezer room for the factory. These are almost always single-tenant facilities dedicated to that one producer, and they are absolutely critical link points in the supply chain. If Americold's freezer breaks down, or even if it just gets too full,
The factory has to shut down.
the entire production line has to shut down. You can't run the factory if you have nowhere to put the finished product.
That sounds incredibly sticky. I mean, if I'm the French fry guy, I can't just get mad at Americold and switch to a competitor down the street.
You can't. What are you going to do? Put hot, partially cooked French fries on a truck and drive them 3 hours down the road to a Lineage Logistics warehouse? The product would be ruined. It is physically impossible. That customer is a captive audience.
Okay, that's a powerful moat. Then we have retail distribution, which is about 21%.
Right. These are dedicated distribution centers for the big grocery chains themselves. Think of the Walmarts, the Krogers, the A-Holds of the world. These facilities are often managed specifically for that one retailer's unique supply chain needs.
And finally, the smallest slice is ports at about 13%.
These are your high-turnover import and export hubs. So if you're bringing in lamb from New Zealand or frozen fruit from Chile, it hits the port facility first before it gets distributed into the domestic network.
Okay, so they've got the whole chain covered. The factory, the city hub, the retailer, and the port. That leads us directly into this idea of their economic mode. And I saw a stat in the briefing that, honestly, it made my jaw drop, but I want to push back on it a little. They cite customer entrenchment.
It's their favorite slide in every investor deck they publish. And for good reason. The top 25 customers have an average tenure of 39 years.
39 years. That is longer than most modern marriages. But I have to ask, is that genuine loyalty or is it just inertia? I mean, in most industries, if a competitor comes along and undercuts your price by 5%, you switch. Why aren't Tyson or Conagra moving down the street to save a few pennies a pallet?
It's a great question, but it's not inertia. It's deep, deep integration. You have to look beyond the single warehouse and look at the network effect.
What do you mean?
These huge food companies, the Tysons, the Kraft Heinz of the world, they don't just use one Americold warehouse. On average, those top customers are using 16 or 17 different Americold sites across the country.
So they're plugged into the entire network. Their IT systems are linked.
They are inextricably linked. Americold's inventory management system, their warehouse management system, it talks directly to the customer's ERP, like an SAP or Oracle system. The customer has real-time visibility into where every single pallet of their product is anywhere in the nation.
So if you're a supply chain manager at Kraft, you just log in and see your whole frozen footprint.
Exactly. So now, imagine you want to switch providers. You're not just moving a few boxes from one building to another. You are ripping out the entire nervous system of your supply chain. You'd have to find a competitor who could replicate that 16 or 17 node footprint simultaneously, with a technology platform that can integrate just as seamlessly. The switching costs are astronomically high.
It's the pain in the neck factor multiplied by 17. That makes a lot of sense. Now, there's another layer to this moat that they've been deliberately building, which is the fixed commitment pivot. And during 2026, they hit a really big milestone here.
They did. 60% of their rent and storage revenue is now under fixed commitment contracts.
Why is that such a big deal? Explain that.
Okay, so think about the volatility of the food business. Harvests can be bad one year, driving volumes down. Consumer trends change. A product could be hot one year and not the next. If you are Americold and you are paid purely on a throughput basis.
Meaning you get paid for every pallet that moves in or out.
Correct. If you're paid that way, your revenue is going to bounce around like a ping pong ball.
Yeah.
It's totally unpredictable.
Right. If the corn harvest is terrible, you've just got empty rooms and you're making no money.
Exactly. But with a fixed commitment contract, the customer is basically leasing the space. It's like renting an apartment. Even if you go on vacation for a month, you still have to pay the rent.
The space is reserved for them.
The space is reserved. So whether the customer puts one pallet in there or 10,000 pallets, they are paying for that capacity. It insulates Americold's cash flow from the physical ebbs and flows of inventory.
It puts a solid floor under their revenue stream.
It puts a floor under their revenue. And as we pivot to the financials in a minute, you're going to see why having that floor is absolutely essential right now, because the physical volumes have dropped.
Which brings us perfectly to part two, the storm. Because despite that contractual floor, the roof has been leaking. We just got the full year 2025 numbers today. How bad was the hangover from last year?
It wasn't pretty. I mean, on the top line, total revenue fell 2.4% in 2025, down to about $2.6 billion. But honestly, revenue numbers can be noisy because of things like power pass-throughs.
Okay, so what's the number that really matters?
The number that really hurts, the one that makes real estate people physically wince, is occupancy. Economic occupancy dipped significantly. It was down 130 basis points just in the fourth quarter, ending the year at 76.1%.
76% occupancy. So that means, what, basically 1 out of every 4 pallet positions in their entire network is just empty air.
It's empty air. And in a refrigerated warehouse, that's a killer. You are paying the massive electric bill to cool that empty air. You're paying to freeze nothing. It is highly, highly inefficient. You really want to be in that 85% to 90% sweet spot for profitability.
So why the big drop? I mean, people still need to eat, right?
Yeah.
The population is growing. Why is the food disappearing from the freezers?
It's a mix of three distinct factors hitting all at once. The first one is destocking.
Destocking.
During the pandemic and the supply chain crisis of 22 and 23, food companies absolutely panicked. They were terrified of running out of product, of seeing empty shelves, so they hoarded inventory. They stuffed every single freezer they could find to the absolute rafters.
So they just over-ordered to create a buffer.
A massive buffer. They went from just-in-time inventory to just-in-case. Now, supply chains are flowing smoothly again. The panic is over, so they're burning off all that excess fat. They're letting their inventory levels fall back to normal.
Okay, so that factor, at least, is temporary. That should normalize.
Theoretically, yes. The second factor is the end consumer. You know, high inflation has genuinely changed shopping behavior. People are buying slightly less volume. They're a little more conscious of food waste. That has a small but real impact.
And the third factor?
This is the scary one, and it's the most structural, speculative cold storage development.
Competitors building new warehouses.
Yes. During the boom times of 2021 and 2022, private equity and developers looked at the cold storage market. They saw occupancies were at like 95%, rents were soaring, and they said, this is a gold rush. I'm going to build a freezer.
And they build these spec warehouses, meaning without a tenant already signed up.
Exactly. They built them assuming the demand would be there when they opened. And now those buildings are opening their doors in 2025 and early 2026 at the exact moment that demand from destocking is softening.
So you have a classic supply glut.
Yeah.
A flood of new supply chasing fewer pallets of food.
It's economics 101. When supply outstrips demand, prices go down and occupancy goes down.
And that reality is reflected in their 2026 outlook. Management, that CEO Rob Chambers and the incoming CFO Chris Papa, they are definitely not sugarcoating things. They released what the street is calling a down guide.
A significant down guide. They're trying to set expectations very, very low.
Walk us through the key numbers there.
The big one is AFFO. AFFO stands for Adjusted Funds from Operations. For a REIT, that's the holy grail metric. It's basically their distributable cash profit.
Some money they can use to pay dividends.
Precisely. They guided to a range of $1.20 to $1.30 per share for 2026.
And just for context, what did they actually achieve in 2025?
They did $1.43, so we are looking at a 10 to 15% contraction in their core earnings power this year. It's a big step down.
And what about occupancy? Do they expect that to get worse?
They do. They're guiding for another 200 to 300 basis point drop in economic occupancy. So they're basically telling the market, we think the pain continues for at least the next few quarters. It gets worse before it gets better.
And while all this is happening, while earnings are dropping, we have to talk about the elephant in the room, the debt.
The leverage is the absolute pressure point for this entire story. Their net debt to EBITDA is currently sitting at 6.8x.
Okay, for the listener who isn't a CFO or a bond trader, translate that, is 6.8x high.
It is in the danger zone. For a high-quality REIT, you generally want to be cruising along at about 5x, maybe 5.5x. That's comfortable, that's safe. When you get up near 7x, you are driving 90 miles an hour on an icy road. Things can go wrong very quickly.
So what's the actual tangible risk here? Are they going to go bankrupt tomorrow?
No, bankruptcy is not the immediate threat. Their debt covenants are loose enough for now. The real clear and present danger is the credit rating agencies. Moody's and S&P.
Right.
Americold currently has an investment-grade credit rating. It's BBB from S&P and Bay3 from Moody's. That rating is their golden ticket. It's what allows them to borrow money at low interest rates.
And if they lose that rating, if they get downgraded?
If they get downgraded to junk status or high yield, their cost of borrowing skyrockets. All of a sudden, refinancing their upcoming debt becomes incredibly expensive. That extra interest expense eats up all the cash flow that should be going to shareholders as dividends or to maintaining the properties. It can become a death spiral.
So the number one mission for 2026 isn't just make more money, it's the deleveraging race.
That is priority 1, 2, and 3. They have explicitly stated they need to get that leverage metric below 6.0x by year end. That's the line in the sand they've drawn to keep the agencies happy.
Is the debt itself a ticking time bomb? Like, do they have a massive billion-dollar bill coming due next week?
Structurally, they're actually in okay shape for the immediate term. It's not a full-blown panic situation yet. About 86–87% of their debt is fixed rate, so they're insulated from the recent rise in interest rates.
That's good.
And they have no major debt maturities until late 2026, about $250 million, and then another chunk in 2027 of about $330 million. So the clock is ticking, but the final alarm hasn't gone off. They have some runway.
But the stock market is always forward-looking. And clearly, some very large investors were not happy to just wait and see. Which brings us to part 3, the boardroom brawl. Enter the antagonist.
Ancora Alternatives. They are a well-known, and I should say very aggressive, activist investor. They don't play small ball.
They bought a massive stake, right? Something like over 7 million shares in late 2025.
Correct. And when an activist investor buys that much stock, they don't do it to be passive, friendly shareholders. They came in with a megaphone and a list of demands.
What was their argument?
Ancora's core argument was that Americold was chronically underperforming its potential and its peers. They looked at that rising debt, they looked at the falling margins, and they pointed directly at Americold's biggest private competitor, Lineage Logistics.
And Lineage is the other 800-pound gorilla in this space.
The biggest. And Ancora's argument was essentially, Lineage is running circles around you guys. You are bloated, you are inefficient, your cost structure is out of control, and you are destroying shareholder value.
Pretty direct. So what were their specific demands? What did they want the board to do?
Well, they wanted a full strategic review. And in corporate activist language, that is usually code for put a for sale sign on the lawn.
Sell the company.
Or at least parts of it. They specifically suggested selling the international business get out of Europe and Asia, become a North America pure play, and focus on fixing the core. They demanded that Americold slash what they called bloated SG&A costs. And explicitly or implicitly, the ultimate threat was, if you can't fix this company, we will find someone who can, and we will sell the whole thing to private equity.
That is some serious pressure. So did this escalate into a full-blown proxy war? Did they fight it out at the annual meeting with dueling presentations?
They managed to avoid the public bloodbath, which was probably smart for both sides. In December of 2025, just a couple of months ago, the two sides signed what's called a cooperation agreement, a very, very structured truce. It wasn't a friendly handshake. It was more like a negotiated hostage exchange. Under the terms, 2 Ancora-nominated directors joined the board immediately, Joseph E. Reese and Stephen R. Slay.
Let's pause on those names for a second. Who are these guys? What do they bring to the table?
Joseph Reese is the real heavy hitter here. He's a veteran investment banker, a capital markets and M&A guy. He knows how to structure deals, how to buy and sell companies. He's there to evaluate the strategic alternatives. Stephen Slay brings more governance and operational expertise. But the most important part of this agreement wasn't just the 2 board seats. It was the formation of a brand new finance committee.
A new committee? That sounds kind of boring and bureaucratic.
It sounds boring, but in this context, it's actually incredibly aggressive because Joseph Reese, Ancora's guy, was appointed vice chair of this new committee. And its specific stated mandate is to oversee all capital allocation.
Translate that for you. What does that mean in practice?
It means Ancora just put a babysitter in the room where every single major money decision is made. They fundamentally don't trust the existing management team to spend money wisely, so they've put their own guy in there to approve every major expenditure, every asset sale, every new development project.
That is an incredibly tight leash.
It's as tight as it gets without taking over the whole company. And in exchange for that power, Ancora agreed to a standstill. They promised not to buy more than 9.9% of the stock and, crucially, not to wage a public proxy fight until after the 2026 annual meeting.
So the deal was, we will stop yelling at you in public if you let us drive the car for a little while.
Or at least if you let us hold the map and control the brake pedal. And this agreement, this pressure, explains the extreme urgency we are now seeing in the 2026 strategy. When we look at this new 5-point plan that Americold just released, you can see Ancora's fingerprints all over every single point.
Okay, let's get into that plan. Part 4, the strategic response. The company is branding it as the cold storage inflection. CEO Rob Chambers laid out this roadmap to fix the ship. What's step 1?
Step 1 is portfolio pruning, or, as I would call it, the trim.
Cutting the dead weight from the portfolio.
Exactly. For the first time, really, they are looking at their massive portfolio of 230 facilities and asking a very hard question. Which of these are actually losing us money or barely breaking even? In 2025, they already exited or idled 10 underperforming sites. And for 2026, they're targeting at least 9 more for closure or exit.
What happens to the customers in those sites? Do they just get a phone call saying, hey, we're closing, good luck?
No, that's the clever part of the strategy. The plan is to move the customers from these old, often low-margin leased sites. These are buildings Americold doesn't even own, but rents from another landlord.
And then releases to their customer.
Right, a low-margin business. The plan is to move those customers into their nearby owned facilities that currently have empty space because of the occupancy drop.
Ah, so you solve two problems at the exact same time. You stop paying rent on the bad old building, and you fill up the empty, profitable space in your good-owned building.
It's a classic efficiency play. It boosts network density, it improves margins, and it gets rid of your worst-performing assets. You are consolidating your footprint and making it more profitable.
Okay, that makes sense. Step 2 is cost rationalization. This sounds like it came directly from Ancora's Cut the Bloat playbook.
It did. They are targeting $30 million in run rate savings in SG&A. That's selling, general, and administrative expenses and indirect labor. And they want to achieve that by the end of the first quarter of 2026.
By the end of Q1, that is incredibly fast.
It is immediate and painful. It means they are firing people right now, likely in corporate headquarters, middle management, and other support roles. They are also cutting what they call transformational cash spend by $50 million.
Transformational cash spend. That always sounds like consultant fees and expensive software projects.
It usually is. It means you stop all the fancy blue sky long-term projects and you focus on the absolute basics. No more expensive PowerPoint decks about the warehouse of 2050. The only job is to run the warehouse of 2026 as efficiently as humanly possible.
Okay. Step 3 is the commercial pivot. So they're not just cutting, they are trying to chase growth, but in very specific areas: retail, QSR, and convenience stores.
This is a really interesting shift. Historically, the bread and butter of cold storage was just moving big, full pallets of frozen chicken from a producer to a distributor. Simple. But the real growth and the higher margins are now in these high turnover sectors.
QSR, that's quick service restaurants, fast food.
Right. McDonald's, Burger King, Wendy's, and convenience stores. And you have to think about how those businesses have changed.
Gas stations are different now.
Gas stations are totally different. They aren't just selling beef jerky and cigarettes anymore. They're selling fresh sandwiches, frozen meals, coffee, smoothies, salads.
That's true. The Wawas and the Sheetz of the world, they're basically small grocery stores or restaurants now.
Exactly. And that kind of operation requires an incredibly complex and precise supply chain. You're not getting one truckload a month. You need frequent, small deliveries of dozens of different fresh and frozen items. Americold just announced a big partnership win with On the Run, which is a huge convenience store chain in Australia. That is the model they want to replicate globally. High frequency, smaller deliveries, more complex logistics. That's where the margin is.
And speaking of Australia, that brings us to step 4, the international question. Ancora was pushing them hard to sell the international business, just become a North America pure play. But it sounds like management is fighting to keep it. Why?
They are defending their global footprint, and they have a couple of decent arguments. First, they argue that their international debt, specifically the debt they hold in Europe, is actually much cheaper than their U.S. debt right now.
Because interest rates have been lower in the Eurozone.
Right, so holding that cheaper debt actually helps their overall weighted average cost of capital. Selling those assets and paying off that cheap debt would paradoxically make their financial profile look slightly worse.
And the market itself is more fragmented abroad, isn't it?
Very fragmented. In the U.S., it's basically a duopoly between Americold and Lineage Logistics. They are the giants.
Yeah.
But in Europe and Asia, the market is still full of smaller, family-owned, mom-and-pop cold storage shops. So there is a much bigger opportunity to grow via acquisition over there.
So they're pointing to new strategic projects as proof.
Exactly. They're highlighting things like the new DP World hub they're building in Dubai, that's a massive global trade port, and a new, highly efficient rail-attached facility in Kansas City with the CPKC Railroad. These are strategic, long-term assets you can't just replicate.
So they're essentially telling Ancora, trust us, the global map is worth it in the long run.
For now, that's the message. But you can be sure that if the stock doesn't move, or if that debt number remains stubbornly high, that conversation about selling the international assets will come right back to the table. Reese and that finance committee will be watching the international margins like a hawk.
Okay, now, I want to shift gears to part 5.
Yeah.
Because this is the part that I have to say I found most surprising when we were digging through all the research. This is the aha moment regarding GLP-1s.
This is genuinely one of the most misunderstood and fascinating dynamics in the entire food industry right now.
I have to stop you there because that sounds like classic corporate spin. Good news is good news, and bad news is actually secretly also good news. Let's just look at the simple common narrative. Ozempic and drugs like it make people eat less food, period.
That is true.
Therefore, total food volumes drop. Therefore, Americold, which stores food, handles fewer pallets and loses money. I mean, the Kansas City Fed even put out a report estimating a 3% drop in overall food demand if just 10% of adults use these drugs. That sounds objectively, unambiguously bad for a warehouse company.
On the surface, you are 100% right. If the total caloric pie shrinks, the industry that moves that pie also shrinks. But you have to look at what people on these drugs stop eating.
Okay, what goes into the no pile? What are they cutting out?
The data is becoming very clear on this. People on GLP-1s primarily stop craving and eating shelf-stable, ultra-processed junk food. We're talking cookies, potato chips, soda, sugary snacks, all the things that make you feel kind of gross when you're on the medication.
Okay, and where do those things live in the supply chain?
They live in dry storage, ambient warehouses, no refrigeration needed. A box of Oreos or a bag of Doritos can sit on a regular shelf for 6 months. Americold does not make any money on chips and soda. That is not their business.
And what goes into the yes pile? What do people on these drugs actually start to eat instead?
Their diets shift dramatically. They move toward healthy proteins, lean chicken, fish, eggs, and frozen fruits and vegetables, often for things like smoothies. They start craving and eating whole foods.
And where do those things live in the supply chain?
They live exclusively in the cold storage chain.
Yeah.
You have to freeze the fish the moment it's processed. You have to refrigerate the eggs. You have to keep the berries frozen.
So the argument is that GLP-1s cannibalize the dry storage industry, but act as a net tailwind for the refrigerated infrastructure industry.
That is the deep dive counter-narrative. It is a mix shift thesis. Even if the total volume of food consumed drops by 3%, if the composition of the food people do eat shifts by, say, 5% from dry goods to cold goods, Americold comes out as a net winner.
But wait a minute, a pallet is a pallet, right? Does Americold really care if it's holding a pallet of frozen broccoli versus a pallet of frozen pizzas? Is the revenue the same?
No, and that's the other key part. They absolutely care. Because fresh and frozen proteins and produce generally require more of those value-added services we talked about earlier.
Oh, okay. It comes back to the services.
It always comes back to the services. A pallet of crackers just sits there. But a pallet of frozen chicken might need blast freezing when it arrives. It might need USDA inspection services done inside the facility. It might need to be repackaged or kitted. The revenue and margin per pallet is significantly higher for the healthy stuff than for the simple processed stuff.
So it's a genuine quality over quantity shift for their business model.
Precisely. And this trend aligns perfectly with the broader MAHA-supported nutritional guidelines that were mentioned in the source material, Make America Healthy Again. Now, whether you agree with the politics of that or not is irrelevant. The underlying trend toward whole foods is a clear, undeniable trend toward the cold chain.
That's actually a very compelling argument. So the very drug that is terrifying the snack food companies might actually be a long-term benefit for the cold chain.
It is a distinct and, I think, very likely possibility.
All right, let's talk about how they protect the margins they get from that business. Part 6, technology as a margin defender. We mentioned earlier that they are operationally intensive. I have to assume they aren't just using clipboards and spreadsheets anymore.
No, not at all. This is where Project Orion comes in.
This is like a sci-fi movie. Or a NASA space mission.
It is a massive, and I mean massive, technology overhaul. It's a $212 million cloud-based ERP system.
Whoa, $212 million. That is a lot of money for a company that's in the middle of a cost-cutting crusade. Is that a wise use of capital right now?
It's a huge bet, there's no question. But here's the logic. In a warehouse, your single biggest variable cost is labor. You have forklift drivers, you have order pickers, you have packers, you have administrative staff scheduling all of it. If you can use data and AI to optimize the route, a forklift driver takes through a massive warehouse shaving just 10 seconds off every single pallet move. Or if you can perfectly schedule your labor based on when trucks are scheduled to arrive so you aren't paying people to stand around waiting.
The savings add up across a network this big.
You save millions and millions of dollars over time. It is the Uberification of the warehouse floor. And it finally went live across North America and Asia Pacific in 2024 after years of work.
So do we have any actual proof that it's working? Or is it just another one of those expensive software suites that promises the world and delivers headaches?
We actually have some pretty compelling early proof. You just have to look at the margins. In the fourth quarter of 2025, as we discussed, physical volume was down. They moved fewer pallets. Their revenue was under pressure. But their global warehouse same-store services margin increased to 13.9%, up from 12.7% the year before.
Wow. Okay, that's the holy grail, isn't it?
Yeah.
Making more money on less work.
It is. It shows that Project Orion is creating what they call tangible labor efficiency gains. In a low-volume environment like the one they're in, the only way to protect or grow your margins is to become radically more efficient with every single pallet you touch. And they are doing it. Without that technology, their margins would have almost certainly collapsed right along with the volume.
So we have the turnaround plan, we have the new tech, and we have this potential GLP-1 tailwind. Let's bring it all home to part 7, valuation and the final verdict. If I'm an investor looking at Colab today, on February 19, 2026, how do I weigh all this? What's the thesis?
Let's start with the bear case. Why would you avoid this stock?
The debt. It's got to be the debt.
The debt is number one. It's high at 6.8x. Their core earnings, their AFFO, are falling based on that $1.20 guidance. And occupancy, by their own admission, is still dropping. If you are a risk-averse investor, this looks like a classic falling knife. It is a show-me story. You want to see the turnaround actually work. You want to see that occupancy number flatten out and start to tick up before you even think about buying.
Okay, that's the risk. But what is the bull case? What's this asymmetric upside you mentioned at the top?
It all comes back to that replacement cost argument we started with. Based on its current stock price and its projected earnings, the stock is trading at an implied 10% cap rate.
Can you translate cap rate for the non-real estate nerds listening?
Sure, think of it as the annual yield that a property generates relative to its price. So if you buy an office building for $1 million and it generates $100,000 a year in net rent, that's a 10% cap rate.
Okay, simple enough.
Historically, high-quality, mission-critical industrial real estate, especially cold storage, trades at a 5 or maybe 6% cap rate. The lower the cap rate, the more valuable and expensive the building is. So, a 10% cap rate means the public stock market is valuing Americold's warehouses as if they are incredibly cheap, low-quality assets.
But they're not. We just established their mission-critical infrastructure.
Exactly. So how cheap are they? If you tried to go out and build these same freezers today with construction costs where they are, with interest rates where they are, it would likely cost you double or even triple what the current stock price implies the assets are worth. The market is pricing in a permanent disaster scenario.
So the bull case is you're buying a dollar's worth of physical assets for, what, maybe 50 cents?
That's the core of the argument. And while you wait for the market to realize that mispricing and for the operations to recover, you get paid a handsome dividend.
Let's talk about that dividend. The yield is attractive, but is it safe?
The yield is very attractive. Depending on the exact stock price today, it's hovering somewhere between 6.8% and maybe 8.8%. And the payout ratio, they're paying out about 65% of their cash flow. That is sustainable. They can afford to pay that dividend even with earnings falling to their guided range. So you're getting paid a very healthy 7-8% yield to wait for the occupancy cycle to turn.
What's the single biggest risk to that bull thesis? What has to happen for it to work?
Occupancy has to stabilize, period. If it keeps dropping, if it goes from 76% down to 70%, then the operating leverage of the business breaks. The high fixed costs of running a freezer start to eat up all the revenue, and then the dividend would be at risk. And related to that, the speculative supply from competitors needs to stop coming online.
And is it stopping?
It is. The best cure for oversupply is high interest rates. Developers simply can't get loans to build these spec warehouses anymore. The math just doesn't work. So that fire hose of new supply is finally shutting off. That is very good news for Americold as we look out into 2027 and beyond.
So let's wrap this up with a final provocative thought. That Ancora Cooperation Agreement, the truce, it expires right around the 2026 annual meeting.
That is the ticking clock hanging over everything.
If the stock hasn't moved or if that debt number hasn't come down significantly by then, what happens next?
Ancora's patience will run out. And private equity is circling this space constantly. We know that big infrastructure funds and specialized firms like Cube Cold and Constellation Cold have been very aggressive in trying to consolidate the industry. There is a lot of dry powder in private equity just looking for stable, long-life infrastructure assets like these.
So the final question really becomes, is Americold worth more dead than alive?
Meaning, is it worth more if it's broken up and sold off in pieces to different buyers? Or taken private entirely by one big fund that can stomach the leverage away from the public eye? It's a very, very real possibility. If the current management team fails to execute on this 5-point plan this year, Ancora will almost certainly pivot from being a cooperative partner to agitating for an outright sale of the company. So when you buy Cold E stock today, you're primarily betting on the operational turnaround. But you also have that M&A thesis as a potential backstop. You have a floor on your valuation because the physical assets are just so valuable to a private buyer.
It's a high-stakes game of freezer tag with billions of dollars on the line.
It certainly is.
All right, let's wrap this deep dive up. We have covered the perfect storm, the oversupply, the high debt, and the intense activist pressure.
And we've covered the life raft they're trying to cling to, the aggressive deleveraging, the deep cost cuts, and that fascinating counterintuitive GLP-1 protein shift.
It is a complex story, for sure. It's a company at a true inflection point, but one with huge potential if they can execute this plan. As the company says in their new motto, risk defined, portfolio protected.
Couldn't have said it better myself.
Thanks for listening to this deep dive into Americold. Keep your portfolios warm and your assets frozen. We will catch you on the next one.